A new dollar is created. No printing press, no announcement, no headlines, just a number appearing on a screen and almost nobody notices. Imagine this. You walk into a bank and ask for a loan. Maybe it's for a car, maybe a house, maybe to start something new. The bank checks your income, your history, your risk. Then they say yes. And in that moment, something strange happens. The bank doesn't go into a vault and pull out your money. It doesn't transfer it from someone else's savings account. Instead, it simply types it into existence. Your account balance goes up. And just like that, new money enters the system. Not metaphorically, literally. Created. This matters more than it sounds, because most people think money already exists, and banks just move it around. But that's not how modern finance works. In reality, the majority of money in the global economy is created by private banks. When they issue loans, not governments, not central banks, banks. And it happens quietly, constantly, every day. Let's slow this down, because this is where things get uncomfortable. When you take out a loan, the bank creates a deposit in your account. That deposit is money. You can spend it, transfer it, invest it. But at the same time, you now owe the bank that exact amount, plus interest. So one side of the balance sheet expands, and so does the other. Money is created alongside debt. They come into existence together, always. Now zoom out. This isn't just your loan. This is happening across millions of people, businesses and governments. Every mortgage, every business loan, every credit line, each one creates new money. And over time, this is how the money supply grows, not through printing presses, through lending. But here's where it gets interesting. If money is created when loans are issued, what happens when loans stop? Think about it. If banks slow down lending because of risk, regulation, or fear, then new money stops entering the system. But old debt still exists. They still need to be repaid, which means money starts disappearing, because when loans are paid back, that money is effectively destroyed, deleted from the system, the same way it was created, just in reverse. So the system has a hidden requirement. It needs continuous borrowing, not just for growth, for stability. And that creates a strange kind of pressure, because for the system to keep functioning smoothly, someone, somewhere, always needs to take on more debt. Individuals, corporations, governments, someone has to keep the machine running. Now layer in interest. This is where the math gets uncomfortable. When a bank creates a loan, it creates the principal amount, but it does not create the interest. That has to come from somewhere else in the system, which means collectively, borrowers are competing for money that doesn't yet exist, unless more loans are created. This is the loop. New loans create new money. New money helps pay old debts. Old debts require more money, which requires more loans. And the cycle continues. At first, this feels like growth, more credit, more spending, more investment. The economy expands, assets rise, confidence builds. But beneath that, the system is quietly becoming more dependent on itself. More debt, more money, more debt. And then something shifts. Maybe interest rates rise, maybe risk increases, maybe confidence breaks. Suddenly, lending slows. And when lending slows, money creation slows, but the debt remains. This is where cracks start to show. Businesses struggle to refinance. Consumers pull back. Asset prices wobble because the flow of new money, the thing that was quietly supporting everything, begins to dry up. This is why financial crises feel so sudden. They're not just about panic. They're about the system losing its ability to create new money fast enough to support existing obligations. And yet, most people don't see this part. They see markets rising or falling. They see inflation, interest rates, headlines, but they don't see the underlying mechanism, the quiet creation of money through debt. Now, let's bring in central banks, because this is where the story usually gets simplified. People often assume central banks print money. And yes, they can create base money, reserves, currency, but most of the money you interact with, your bank balance, is created by commercial banks, not central banks. Central banks influence the system, they set interest rates, they adjust liquidity, they try to guide behavior, but they don't directly control how much money is created. That depends on lending, and lending depends on confidence. Which makes the system psychological as much as it is financial, because if banks feel confident, they lend more. If borrowers feel confident, they borrow more, and money expands. But if either side hesitates, The system tightens. This is why small shifts can have large effects. A slight increase in rates, a change in risk perception, a policy adjustment, these can ripple through lending behavior and quietly change how much money is being created. Now consider this, if most money is created through debt, then a large part of the economy is built on obligations to the future promises repayments, expectations, which means growth isn't just about productivity or innovation. It's also about the ability to sustain and expand those promises, to keep the system moving forward. And this creates tension because debt can accelerate growth, but it also accumulates risk. Too little lending and the system stalls. Too much and it becomes fragile. There's no simple balance, only constant adjustment. Now here's the part HAT often gets misunderstood. This system isn't necessarily broken. In many ways, it's incredibly effective. It allows capital to FLE quickly. It supports investment. It enables expansion, but it also has side effects. It tends to amplify cycles. It can inflate asset prices. It can concentrate risk, and it can make the system feel stable right up until it isn't. Because when money is created quietly, its disappearance can be just as quiet until suddenly it's not. Think about housing markets. When lending is easy, prices rise. More mortgages, more money, more demand. But if lending tightens, the reverse happens. Less money entering the system, less demand. Prices adjust. The same pattern shows up in markets, in businesses, in entire economies. Because beneath it all, the same mechanism is at work. Money creation through debt. And here's the irony, the system feels most stable when it's expanding the fastest, when credit is flowing, when money is being created easily, but that's also when it's building the most pressure. Because expansion today often means obligations tomorrow. So we end up in a strange position. We rely on a system that needs continuous growth to remain stable, a system where money is created as debt and destroyed when that debt is repaid. A system that works best when people are willing to take on more risk, but becomes fragile when they don't. And most of this happens without most people noticing. No headlines when a loan creates money, no alerts when it disappears. Just numbers changing on screens, quietly shaping the economy. So the next time you hear about rising debt, falling rates, or tightening credit, it's not just policy, it's not just markets, it's the underlying engine of money itself, speeding up or slowing down. And maybe the real question isn't just how money is created, but how long a system can depend on creating money this way, before the balance between growth and stability becomes impossible to maintain. And because if money is born from debt, what happens when the system can't take on anymore?